Tesla delivered 480,126 vehicles in the second quarter, its strongest Q2 result ever. Revenue increased by almost $5.9 billion from the previous quarter, and energy deployments remained very strong. But automotive margins fell sharply, operating expenses reached record levels, and free cash flow turned negative. So let us begin with a quick overview of the quarter, before examining whether this was the beginning of a new growth phase, or mainly a strong recovery from a weak first quarter. Let us look at the numbers. Tesla generated total revenue of $28.24 billion in the second quarter, up from $22.39 billion in Q1. Automotive revenue increased to $20.52 billion, while energy revenue reached $3.14 billion. Services and other revenue produced another record at $4.58 billion. One interesting development is Tesla's changing revenue mix. Automotive represented around 80% of total revenue in 2024, but its contribution has now declined to approximately 73%. This does not mean that Tesla's automotive business is shrinking. Instead, services and energy are becoming larger parts of the company. Services revenue, in particular, increased by approximately 50% year over year. This includes activities supporting Tesla's growing vehicle fleet and ecosystem, giving the company some diversification away from relying entirely on new car sales. Unfortunately, the strong revenue growth did not translate into equally strong profitability. Tesla's total gross margin declined from 21.1% in Q1 to 16.8% in Q2. Automotive gross margin fell from 21.1% to 16.9%. Excluding regulatory credits, automotive gross margin declined from 19.2% to 16.3%. Tesla attributed this pressure to lower average vehicle selling prices, customer incentives, financing support, product and geographic mix, lower regulatory credit revenue, and costs associated with increasing production and deliveries. Regulatory credit revenue also declined from $439 million last year to only $146 million this quarter. Because these credits have very little associated cost, their decline created a disproportionately large profit headwind. Energy gross margin fell even more sharply, from 39.5% to approximately 20.4%. Tesla identified warranty charges involving a supplier's battery cells as one reason. Therefore, energy revenue and deployments were strong, but a large portion of the segment's potential profit was absorbed by these charges. The positive surprise was services. Its gross margin increased to a record 14.1%. That is important because this business is becoming both larger and more profitable. Tesla's GAAP net margin was 3.9%, but even that needs some context. Tesla reported approximately $1.11 billion of net income, partly supported by a $1.01 billion unrealized gain relating to SpaceX. Operating income was only $398 million, representing an operating margin of approximately 1.4%. That gives us a clearer picture of how limited profitability from the underlying operations was this quarter. If you are getting value so far, do consider to subscribe to the channel. Looking at Tesla's main operating indicators, vehicle deliveries recovered strongly to over 480,000 units. Energy storage deployments also increased to 13.5 gigawatt hours, close to the company's quarterly record. But Tesla is spending heavily to support its next generation of products. Research and development expense reached a record $2.37 billion, while cash and investments remained very strong at approximately $43.5 billion. This balance sheet gives Tesla considerable financial capacity. However, the company is now simultaneously funding artificial intelligence infrastructure, Robotaxi, Cybercab, Optimus, semi, batteries, and new manufacturing facilities. Therefore, the key question is no longer whether Tesla can afford to invest. It is how efficiently those investments can eventually be converted into profitable businesses. Many investors were understandably excited by Tesla's Q2 delivery number. However, Q1 deliveries were unusually low, so part of the Q2 strength may reflect timing differences and vehicles carried over from the previous quarter. To get a clearer picture, let us compare deliveries during the first 6 months of each year. Tesla delivered 838,149 vehicles in the first half of 2026. That was 16.3% higher than the first half of 2025. However, compared with the first half of 2024, deliveries were only around 0.9% higher. So this looks more like a strong recovery from a weak 2025 than evidence of dramatic long-term growth, at least for now. That may also help explain why investors did not respond more enthusiastically to the delivery announcement. One important product to watch during Q3 will be the Model YL. It has already contributed in China and became available in the United States in July. The production data further supports the idea that some of Q2's strength came from inventory carried over from Q1. During the first quarter, Tesla produced 50,363 more vehicles than it delivered. In Q2, the situation reversed, with deliveries exceeding production by 28,368 vehicles. In other words, Tesla sold some of the inventory accumulated during Q1. That is positive for working capital and inventory management, but it also means Q2's delivery pace may be difficult to repeat unless production and underlying demand continue increasing. The encouraging point is that Q2 production was still approximately 43,000 vehicles higher than Q1. Therefore, the quarter was not driven entirely by inventory reduction. Still, investors should be careful about assuming that one exceptionally strong quarter automatically establishes a new growth trend. Tesla generated $4.70 billion of operating cash flow, which was a strong result. However, capital expenditure increased to a record $5.79 billion, up from approximately $2.49 billion in Q1. As a result, free cash flow turned negative by approximately $1.09 billion. This spending includes factories, AI computing infrastructure, Cybercab, Optimus, battery manufacturing, and other long-term projects. Importantly, capital expenditure is recorded on the balance sheet rather than being immediately recognized as an operating expense. Therefore, this spending did not directly cause Tesla's operating profit miss. It did, however, consume cash, and depreciation from these investments will gradually affect future earnings. Tesla's investment cycle is clearly accelerating. That can create significant long-term value, but only if these projects eventually produce attractive commercial returns. At the same time, Tesla's major operating expenses reached record levels. Research and development expense increased by 49% year over year to $2.37 billion. Selling, general, and administrative expense increased by 45% to $1.98 billion. Stock-based compensation reached $1.15 billion, an increase of 81% from the previous year. Tesla said this included expenses associated with the 2025 CEO Performance Award. Stock-based compensation does not consume cash during the quarter, but it remains a real economic expense because it transfers value to employees and executives and can dilute existing shareholders. These investments help explain the apparent contradiction in Tesla's results. Revenue increased by almost $5.9 billion sequentially, but gross profit increased by only around $31 million, while operating expenses rose by approximately $574 million. Tesla sold considerably more vehicles, but the profit generated from those additional sales was much weaker than investors might have expected. One of the most encouraging developments was the continued growth of FSD subscriptions. Active subscriptions increased to 1.48 million, compared with 1.28 million in Q1, and approximately 950,000 1 year earlier. That represents year-over-year growth of 56%. Tesla reported a record number of net new subscriptions during the quarter. More than 55% of new North American deliveries also included an FSD subscription. This is strategically important because FSD has the potential to create recurring, higher-margin software revenue from Tesla's existing vehicle fleet. The vehicle only needs to be sold once, but the software relationship can potentially continue for many years. If subscription adoption keeps increasing, FSD could gradually make Tesla's revenue more predictable and less dependent on vehicle pricing. Tesla's Robotaxi network is also expanding, although it remains at a relatively early stage. The company reports operations in 7 major metropolitan areas. Austin, Dallas, Houston, Miami, Orlando, and Tampa are described as ramping unsupervised operations, while the San Francisco Bay Area continues using a safety driver. Phoenix and Las Vegas remain in preparation. Cumulative paid Robotaxi mileage is approaching 2.5 million miles. That gives Tesla valuable real-world data, but mileage alone will not determine commercial success. Investors need to watch safety performance, regulatory approvals, fleet utilization, operating costs, and whether the service can scale across different cities without requiring excessive human intervention. Cybercab is especially important here. It is not designed to be merely another Tesla vehicle. It is intended to become the purpose-built workhorse of the Robotaxi network. The first-generation Optimus production line is being installed in Fremont, while a larger production facility is under construction at Gigafactory, Texas. Initial production is expected later in 2026. Early robots are expected to support Tesla's Optimus Academy, where they can collect training data and develop additional real-world capabilities. The long-term opportunity extends far beyond Tesla's own factories. A commercially useful humanoid robot could potentially perform tasks in manufacturing, warehouses, logistics, and other physically demanding environments. But Optimus must still progress from impressive demonstrations to reliable, repetitive, and economically valuable work. For investors, the next evidence to watch will be production volumes, training progress, real-world usefulness, safety, and the cost of manufacturing each robot. The next 12 to 24 months could be one of the most consequential periods in Tesla's history. Cybercab and Robotaxi could move Tesla beyond selling vehicles and into autonomous transportation. FSD could develop into a meaningful recurring software business. Optimus could open an entirely new robotics market. Tesla Semi could expand the company into commercial freight, while Megafactory Texas, Megapack 3, and Megablock could make energy storage a much larger and more dependable growth engine. Behind all of this, Tesla is rapidly expanding AI computing, batteries, lithium refining, and even semiconductor capabilities. The opportunity is enormous, but execution will determine everything. Robotaxi must prove that it can operate safely and economically at scale. Cybercab must progress from early production into meaningful deployment. Optimus must perform genuinely useful work. And Tesla must fund all of these projects without allowing costs and cash consumption to overwhelm its established businesses. Overall, Q2 was a quarter of strong growth, but weak conversion of that growth into profit. Tesla reported record Q2 deliveries, $28.24 billion of revenue, and strong operating cash flow. But automotive margins deteriorated. Operating expenses reached record levels. The operating margin fell to approximately 1.4%, and free cash flow turned negative. So the current Tesla story is not simply about how many Model 3s and Model Ys it can sell. The bigger investment question is whether Tesla can successfully transform itself into a company built around autonomous transportation, recurring software revenue, robotics, energy storage, and physical artificial intelligence. If Tesla delivers on even part of this roadmap, the next 2 years could fundamentally reshape the company. But this is also the period when investors will begin discovering which of Tesla's biggest ambitions can become large and profitable businesses, and which remain expensive promises. We will continue following Tesla's progress and the other major earnings reports coming in the next few days. Subscribe to the channel if you would like to stay updated.